Well, if last week was a bit of a respite from macro event risk flailing the markets to and fro, this week is the polar opposite. This is Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live, and we face an absolute avalanche of macro event risk this week. It surely is the best of all possible times to have it happen to check the sarcasm there, because of course there's the US election coming up the very next week. So, what a time to ask the markets to have directional conviction when just beyond the bounds of this week, another major piece of event risk looms ahead. But this week brings an absolute flood of relevant news flow. And so we're going to look at all of it here, first anchoring ourselves in where things were last week and what the narrative was there, and then going step by step as we get indications on where the global economy is going from all three major sources of growth. Number one, let's first get a sense of where it is that we are, and then take a look at how we may proceed. Key news, as I say, out of the US, out of Europe, out of Asia, all of it potentially market moving. Last week was a soggy one for stocks. We can see here the S&P down 1%. NASDAQ manages to be basically flat on the week, and that's really only thanks to an explosively better than expected earnings report from Tesla. Other than that, we would have been in a much more defensive posture, probably. And that's a familiar story here when we look at what happened in the bond market. Yields up across the board, close to 4% rise, both at the front end of the curve, the 2-year, and the long end, the 10-year. And the response from markets, mostly as you might expect. The dollar up against all of the major counterparts here, up against the euro, up against the yen. Bitcoin down 2% and some change last week. Now, of course, we've had significant reshuffling in this since then. Crude oil, having been up 4.5% last week, is now down aggressively after Israel did the retaliation dance with Iran over the weekend. And it looks like we've put a direct confrontation between these two regional powers back into the box. Bitcoin screaming higher, but probably the more interesting disconnect, the ongoing ignoring of macro narratives that gold is exhibiting. It was up a bit last week. It's holding near the highs today. That's despite reduced geopolitical risk that we see in crumbling oil. That's despite higher yields and despite a stronger dollar. All of which is, of course, very interesting and has a whiff of expectations, or at least defensive pre-positioning for the election next week. We'll see if gold manages to find some kind of traction finally. But the overall story seems to be higher yields, reflation, and with that, a circumspect take from stock markets. And we can see that in the way that Fed policy expectations have evolved here. Note, before the Fed makes its move in September is where the peak in cumulative rate cut expectations occurs between this year and next. In the orange here is the sum of expectations for this year, which is in the gray, next year, which is in the yellow, and in the blue, of course, the S&P 500. What we find is that when the Fed makes its move, it's not exactly the most optimistic or emphatic response from stock markets, and the Fed delivers essentially everything that the market wanted. They deliver the 50 basis point rate cut that the markets were setting up for. They delivered the outlook that essentially started to signal that the markets were right to expect at least 50 basis points more on the docket between November, the meeting coming up right after the election, and December, the last meeting of the year. And what's happened since then has actually shifted expectations to a far less dovish setting. So if we look at where we are currently, what we find is we're looking at 114 basis points in cuts between now and the end of next year. Now, when we take the difference between that and the 229 basis points that we had there right before the rate cut, well, then we see that that's a very significant difference, even after we factor out the 50 basis points that have already occurred. The markets have shifted 65 basis points, holding aside that 50 basis point cut that obviously was already something that was on the menu, to a less dovish setting. And as we can see here, things were holding relatively steady now for a while for this year's odds. And the real mover here over the past 2-3 weeks has been what happens for 2025. And all of that has seen rate cuts come off the board, largely because U.S. economic data has been getting progressively better. This is the Citigroup Index of U.S. economic data surprises. And as we can see, we are at this point back to where we were in the first half of April, give or take. We are now looking at some of the best performance for U.S. economic data, again, relative to expectations, since really the concern about maybe the Fed is going to miss the window, maybe there's going to be a recession and they'll be too late to cut, since that began to germinate. And that was mid-April. What we're seeing here is a very brisk recovery. And we've seen it occur in the PMI data. We've seen it occur in the last set of inflation numbers, in the ISMs. We've seen it happen in retail sales. U.S. economic data is telling the story that the Fed is not going to be able to cut with as much vigor as both it and the markets thought. And that's because the U.S. economy is hotter. Against that backdrop, of course, stocks have idled. Yields have continued to push higher. The dollar has followed them, and bonds are down. So it is with this overlay that we look at a week ahead now that will give us something to watch for out of each of the major engines of global growth. We can see here 58% of global GDP is made up conservatively of the US, the Eurozone, and China. Why conservatively? Because most of the rest of the world, the other 42%, depends on the former three for demand. They are vendors to the former three. And so the influence of the US, the Eurozone, and China is actually much larger than even their 58%. We're going to get something to look at from each one of them, with Asia and the Pacific region first up. Here, initially the focal point, the quarterly inflation report out of Australia, where the headline CPI number is expected to come down in the third quarter to 2.9%. That is, of course, a very significant downtick relative to where we were before, and you can see that on the chart here clearly. It would be the lowest that we'd seen since the first quarter of 2021. Perhaps this is finally going to give some impetus to the RBA to want to cut interest rates. So far, it has been one of the few, if not the only, major central bank that has held out. And the expectation at this point is we are not pricing in a cut before year end. So how this proceeds from here should be very interesting indeed. If we look at what's on the menu for next year, the markets are looking at just 54 basis points in cuts. So 2 reductions next year at some point. If that starts to look like we're going to get either more cuts next year, because of course we're getting long in the tooth for 2024 at this point, or that perhaps the RBA will have the ammunition that it needs to squeeze at least one of them off before the calendar turn, then that would be a very interesting sign of things to come. And of course, part and parcel of the weakness that we've seen regionally, which will again be on display as we get Chinese PMI numbers. Once again, here we can see for all of the readjusting back and forth, the composite index here expected to be at 50.6, giving us yet another month of near standstill. That's as we get a little bit of an improvement in both services and manufacturing, the latter expected to essentially return to standstill after another long stretch of several months in contraction territory. The PMI numbers, as ever, have a 50 at the center. That's neither expansion nor contraction. Above 50 is expansion. Below 50 is contraction. The further you go above, the faster the expansion. The further you go below, the faster the contraction. And so what we have here then is Australia's largest trading partner and by far the dominant source of demand for generally commodity exporters, be they in Africa or in parts of Latin America or in Australia or in New Zealand or in Southeast Asia. And the message still is, stimulus efforts notwithstanding, this economy is stuck. In fact, we've just recently seen the latest set of GDP numbers here showing us that for the 6th consecutive quarter, China is in economy-wide deflation. You can see that because real GDP continues for the 6th consecutive quarter to outpace nominal GDP. So if nominal is equal to real plus inflation, the only way real becomes a value above that is if inflation is negative. So a total absence of demand, in other words. If that were to be what we get in these PMI numbers, and Chinese data has tended to surprise on the downside, as has Australian data more recently, we get the sense that the price to pay will be for the Aussie dollar, which is already sinking, of course. In fact, a notable underperformer relative to some other currencies against the greenback. It is now back to the lowest since the middle of August. It may continue to break lower this week if it looks like both regional growth and the RBA's reaction function to it are going to give more room for rate cuts. Next, we turn to Europe. Here we're going to get third quarter GDP numbers out of the euro area. Expectation is that output is going to grow 0.8% year on year. That would be a slight improvement over 0.6% in the second quarter. And then we are going to get inflation numbers. The German ones will come first, and then these region-wide numbers will follow. The expectation for a slight uptick from 1.7 to 1.9% year on year. Nevertheless, a second consecutive month under the ECB's target. And that may start to fuel speculation that the ECB may go still more dovish, still more aggressive on stimulus, especially as economic data from that region continues to miss the mark. In fact, we just saw the PMI numbers last week, and they continue to point to awful conditions growth-wise in the Eurozone, a second consecutive month of contraction. And what we're looking at here then, in so much as we're looking for a little bit of an uptick in both GDP and CPI, leaves room for downside surprises to drive meaningful repositioning. Because if these numbers miss, as has been the case in Europe frequently in recent weeks, then the outlook for the ECB doesn't look dovish enough in relative terms, and that may give us a still weaker euro. It's currently sitting at some critical support right above the 107 figure, just under 108. So 107.50, 107.80, a key area there, and defining the up move since back in October 2023. So if there's a downside push here for the euro, there's the possibility to make a major lasting breakdown. And then, of course, there is the main narrative. And here, as we turn to the US, things get spicy. First, we are going to get the Fed's favorite inflation gauge, the PCE index. Here, we're looking for headline inflation to continue to come down, 2.1% on the headline here. The core seen ticking down back to 2.6% after the unexpected pop to 2.7% in the prior month. Generally speaking, these numbers are not terribly market moving because by the time these come out, CPI is already out, the PPI report is already out, and the markets are generally fairly good at benchmarking what this means and what these numbers are likely to come out as in turn. So wild deviations from expectations are unlikely here. Nevertheless, much of the driving force behind the lower headline inflation numbers has come from energy. And the Fed has no agency there. The Fed is looking through what's going on with food. It's looking through what's going on with energy because there's nothing that they're going to do with interest rates that's going to change those things. Likewise, housing is basically locked until more rate cuts come and unfreeze the market for both buyers and sellers. Sellers ostensibly are freezed out because they don't want to sell since they're sitting on mortgages financed much, much cheaper than what's available in the market now. That means the prices can adjust lower. If they can't adjust lower, then that, of course, squeezes out buyers. And so meaningful change is unlikely there until the Fed has a deeper way into its cutting cycle. The real area of interest then is services. And this has been the bogey for the Fed for quite some time. This is where inflation continues to live. Here, the approximation is core PCE, which is at 2.6%, expected to be in an unwelcome standstill of a range for now several months. It's a little bit of a downtick from the 2.7 number that we got last go around, but nevertheless, it is well within the range prevailing since May, which is when you could say that improvement in CPI has basically been arrested. It was 2.8 in April, then 2.6 in May, 2.6 in June, 2.6 in July, 2.68 in August, and now expected 2.6 again in September. We've seen how the Fed reacts to core inflation stalling on its way lower. It gets antsy about cutting rates. We saw this already toward the end of the second quarter going into the middle of the year this year. So if core holds up here, or even perhaps registers a bit hotter than expected, the narrative we've seen, higher yields, lower bonds, stronger dollar, soggy stocks, gets another reason to continue. It is the same story when we get to third quarter GDP data, where for a second consecutive quarter, we're expected to see growth annualized of 3%. Needless to say, that is, of course, very chipper relative to what's happening in other economies, China at standstill and the Eurozone back in contraction mode. But it would be, in essence, something along the lines of the status quo that has emerged in the recent range, with about the low twos on the bottom and the sort of four to three and change at the top. And so we're looking at here a print broadly in line with where we've settled, let's say, in the aftermath of COVID's sort of first aggressive slowdown, then aggressive ramp up that we see is giving us these overstated values. In fact, the average since this massive jump of 35% after this massive fall of 28% is 3.3%, just in line with what we're looking at here. And if we look at the average for where we've been over the past 4 quarters here, just to give us a kind of running annualized tally, that's at 2.9%. So we're very close to baseline if we come out as expected. But again, U.S. economic data has tended to surprise higher and by an increasing margin, which creates room for this too to beat and then give us, once again, higher yields, lower bonds, stronger dollar, wobbly stocks. And finally, for the crescendo, Friday's U.S. jobs report. Expectation here that we're going to see 140,000 added to non-farm payrolls. That would be a step down from recent values. As a matter of fact, it would be the weakest reading in quite some time. You'd have to go back to April of this year and perhaps June to get something comparable. 118 in June, 108 in April. So right around that soft pocket toward the end of the first half and into the second half of the year. That's right here. So needless to say, not a high bar to clear for U.S. economic data that's tending to surprise on the upside. The unemployment rate seen holding steady at 4.1%, and wages, tellingly, seen holding steady at 4%, which gives us yet another month where wages outpace inflation. Again, inflation here, as we just saw from the PCE numbers, well below 4%. That's here, which essentially means that since about the tail end of 2022, beginning of 2023, wages have been running hotter than inflation and continue to do that based on the expectations for this report, all of which seems to be a tailwind for the U.S. economy, envy of the world though it is already, and seems to engender this continued outperformance for services because, of course, to the extent that this boosts consumers' purchasing power, it also boosts their demand for domestic services, where most demand has gone recently, at least since this goods upswell in 2021 petered out. And again, if these numbers surprise higher, the story is the same. Higher yields, lower bonds, stronger dollar, wobbly stocks. The real question for stock markets here is, will they choose to roll over or will they forestall judgment one way or another because the election follows just on the heels of all of these releases? That is macro money for today. As we always do, we will dig into these releases in more granular detail as we proceed throughout the week. We're here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may follow thereafter. I'm on with Victor Jones on Wednesdays for The Price of Truth, on with Chris for Futures Power Hour, both Mondays and Fridays. Back with Victor and Tom for First Call Sundays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter. at Ilya Spivak. If you're watching this on YouTube, like and subscribe. And Macro Money's back tomorrow. Happy trading.